Hello, I'll be doing the Session 9 assignment. And so the overview is calculate the weighted average cost of capital, also known as WACC, for Netflix in connection with the hypothetical $5 billion content investment decision. And your analysis must determine current WACC, evaluate the impact of additional debt financing, s- says project specific versus firm-wide discount rates, and compare Netflix's cost of capital to industry peers. And some hypothetical for the Netflix financial parameters are that the market capitalization is at $200 billion, total debt is at $14 billion, the debt is at $13 billion. Excuse me. The equity beta is at 1.3, bond rating BBB plus, which has a yield of 5.8%. The corporate tax rate is at 21%. The current stock price is at $450, and the market conditions are risk-free rate of a 10-year treasury at 4.5%, the market risk premium at 5.5%, the media industry WACC range at 8 to 10%. In strategic context is Disney capital structure, 70% equity, 30% debt, with a WACC of 8.2%. Amazon Prime Video uses Amazon corporate WACC at 9.5%, and Netflix considering $3 billion additional debt issuance for content investment. And so the required analysis are to calculate Netflix's current WACC, determine WACC after $3 billion debt issuance, evaluate project-specific WACC, compare Netflix WACC to Disney, explain differences, and recommend optimal capital structure strategy. And so I put this into Gemini, and I'm not gonna get into everything that I did, but I'm gonna just break down things that it did. So start with the strategic imperatives. It says capital structure optimization. The firm must immediately and deliberately realize moderate debt to capitalize on the tax shield benefits and lower the overall cost of capital. This secured low-cost funding is vital for sustained aggressive content investment. Project appraisal policy. The policy of using a single firm-wide WACC is financially precarious. The analysis mandates the immediate implementation of segmented risk-adjusted discount rates. For content project evaluation, this framework must incorporate explicit country risk premiums for international content to accurately reflect regional cash flow, volatility, currency risk, and geopolitical factors. The competitive posture is Netflix currently operates with a higher cost of capital compared to diversified rivals like Amazon and arguably Disney. This structural WACC disadvantage necessitates meticulous financial planning, focusing on superior capital efficiency and high required returns on content investments compared to competitors. And to establish the foundation, so the market value of equity is derived from recent market capitalization figures as of November 13, 2025. Netflix market caps, it was at $482.64 billion, while the figure for November 18, 2025 was $467.33 billion. For valuation purposes, the analysis establishes a baseline market value of equity of $475 billion. And this high valuation reflects investor confidence in Netflix's global subscriber base and substantial free cash flow generation, 8 billion plus annually expected. So the market value of debt is approximated using book values for long-term borrowings, as debts tend to trade close to par. And so Netflix's long-term debt at the end of September 30 was $14.463 billion. And that value of it utilizes a market value of debt of $15 billion, incorporating long-term debt with a minimal approximation for short-term liabilities. And the capital structure weights based on the figures is the total capitalization is at $490 billion, which is adding the you get that by adding the $475 billion and the $15 billion. And that means the equity weight is approximately 96.9% and the debt weight of approximately 3.1%. And so for the cost of equity calculation, we look at the risk-free rate is just proxied by the yield on long-term government bonds reflects the return available on a riskless investment. The 10-year US Treasury yield was 4.2% as of November 18, 2025, and it closely aligned with the 4.2% rate reported at the end of August 2025. The rate of 4.2% is used for precision. And for the equity risk premium, you can see that's 5%, 2.2%. The levered equity beta is reported at 1.58%. So if we do the cost of equity calculation, you can by doing the 4.12% plus 1.58 times 5%, which will equal 12.02%, which is the resulting cost of equity. And the cost of debt is has a yield of 4.045% and a bid yields around 4.192% as of November 2025. And if we look at the effective corporate tax rate, by using this formula, you can get the 3.28%. And the after tax cost of debt, 3.28%, which is less than one third of the cost of equity, which is 12.02. And to move on to the Netflix current weighted average cost, WACC, if we use all the data that we're given on top, we'll get the WACC, which equals to 11.75%, which is like an approximation. And it represents the appropriate discount rate for cash flows associated with an average risk Netflix project. And the high value is primarily attributable to the company's reliance on equity financing and its high operational volatility, beta of 1.58, within the intensely competitive streaming sector. And this is the summary of the WACC calculation from the risk-free all the way up to the baseline, the weighted debt. So the impact of a $3 billion debt increase. So this is where we modeled the $3 billion incremental debt load. The scenario inputs are the new debt that we find, the total capitalization right here, the new debt weight, and the new equity weight. And if we do all that calculation, well, we can see this on the top of the 11.69%. And some analysis of capital structure optimization at the margin is the $3 billion debt. It reduces the WACC by 6 basis points from an 11.75% to 11.69%. And the conservative financing policy of the past, characterized by an overwhelmingly large equity weight, is reflected in the fact that the introduction of low-cost debt immediately lowers the overall cost of the capital. And this is the table that shows the sensitivity of WACC to $3 billion debt increase. And this is where we find the segments, which is firm-wide discount rates. Here's the geographic risk. It says adjustments for market maturity and sovereign risk, particularly for the 56% of revenue derived internationally. So if we look at the international content, this is the formula that we would use. And so Netflix revenue in the US and Canada is 44%, 32% from EMEA, 12% from Latin America, 12% from Asia Pacific, and it, the complexity of assessing risk across these regions, especially considering that the Asian segment alone accounts for 50% of anticipated international growth. That dictates the highly variable discount rates. And this is all the um, international places that's taken the information from. If we look at this, this is where we compare the WACC values and structural data. So for Netflix, it's an 11.75% value, and Disney, you can see that 7.03% to 12.44%. For Amazon, it's 7.32% to 10.8%, and beta is 1.58. For Disney, it's 0.8 to 1.5 implied, and for Amazon, it's not listed. The deadweight market for Netflix is 3.1, for Disney, it's 15.44%, and for Amazon, it's 2.09%. So the published WCC figures for Disney show massive divergence ranging from 7.03% to 12.44%. And this discrepancy is almost entirely due to different inputs for the cost of equity calculation. This is and the conclusion for the Disney is The conclusion is that the lower WACC best represents Disney's conglomerate structure, while the higher WACC likely relies on outdated or typical inputs that fail to capture the stabilizing effects of its diversified portfolio. And for Amazon, it's calculated based on extremely low debt weight and very low cost of equity. And the higher 7% WACC, it reflects the aggregation of the broader consumer discretionary sector. And so the advantage is the conglomerate advantage that we can find is both Amazon and Disney benefit from the conglomerate effect. Their streaming divisions are financed by lower corporate WACC due to the stability provided by other segments, AWS for Amazon and Parks Broadcast for Disney. Amazon Prime Video in particular operates one of the lowest costs of capital among streaming services, allowing it to prove content projects with much lower expected returns than Netflix. Netflix is a pure play content expenditure company and it's highly sensitive to market swings and the intensity of the content arms race which is reflected in the high equity beta of 1.58. This direct exposure results in the cost of equity of 12.02% and a WACC of 11.75% that are structurally higher than those of rivals leveraging platform diversification. And Amazon's low WACC means it can intentionally subsidize its content spending setting higher competitive barriers and potentially driving up content costs for the entire industry. To overcome this WACC gap, Netflix must maintain superior operational and content efficiency, ensuring that its content projects consistently clear the high your 11.75% hurdle rate. And this is where all the sources were got all the sources or Gemini got all the sources. So yeah.